Good afternoon, ladies and gentlemen. Welcome to today's stock market brief show. I've been seeing a lot of these analog charts show up in the social feeds from 2011, from 2022. And well, in last brief that we talked about how very similar here in the late 90s going into the top of the dot-com bubble, we saw a 23% drawdown. So I wanted to give my take of where we stand right now within all of that. But I want to do more. I want to hone in kind of on the seasonality of what it looks like here for the remainder of May. We're going to hop into some signal charts as well. We're going to get into the expected moves, market conditions, and even show a potential scenario of individual stocks squeezing, meaning that they're high short interest names that have been contracting and that have the potential that if we get tweeted upon, they may very well squeeze higher. All that and more on today's Stock Market Brief show. These episodes are brought to you with my partners, Interactive Brokers. If you haven't checked them out, pinned comment, take a look, check out their interactive campus. It's absolutely free. They give the Traders Academy, Traders Insights. They have webinars, podcasts. Those courses that they have are from beginner to advanced. And then also a big shout out to my Patreon community that continues to show up and show out the support. It's only $9 a month. You can sync your Discord up to it and you get all these benefits down here, including my weekly tight list, which I'm going to show you a version of that I called the squeeze list that I created today of all those stocks that started to squeeze. Let's get into today's episode. All right, people, welcome back to the show. I didn't say it at the beginning of the show, but I recorded this entire episode with my mic muted, and now this is my second go around, and trust me, there was a part of me that was like, dude, I'm just not going to do it, right? But it is what it is. I'm here. All right, so this was the larger term, bigger picture chart that I've been sharing on the monthly time frame for quite some time. And we get our yield curve down here that uninverts. And during that time where we start to steepen and the Fed starts to cut rates, we've noticed volatility in the market, right? This over here was the pandemic, right? We call that a one-off, minus 35%. You over here, the great financial crisis and the dot-com bubble. And we're kind of at that area where the curve is starting to steepen, right? We inverted, right? We uninverted, we inverted again, and we're moving out just like this. Boom, 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 just like this. Boom, 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 and then not like quite like that. But if you do look back over here where we had these new highs during these kind of same scenarios, you do notice there's been periods of times before even heading higher that we saw some pretty big pullbacks. For example, in 1998, we saw a 23% pullback right here before squeezing out higher in the markets before eventually rolling itself over. And then over here, you can see we had from this high to this low, very tiny looking, but it was actually a minus 13% drawdown before reaching out to new highs. And I bring that up because we just recently had a 23% drawdown, and that's pretty similar to over here. And I've been seeing some interesting scenarios that look like 2011, right? Or back in 2022, and we've been seeing these analog charts. And really an analog chart, they don't have any predictive power, but it does lay out potential paths and gives you awareness of what things can have the potential to look like based off of history, based off of what has happened in the past. It's like Mark Twain saying, right? History doesn't tend to repeat, but it often rhymes. Well, this red line is the S&P 500 now, right? We went through that 23% drawdown. So if I kind of layer these on top of each other, this right here is the first official bear market pullback of 1998. And you can see we drew down very hard there too as well before rallying to new all-time highs. So the thought here is really to just combat what I've been seeing about the 2011 and the 2022 analogs and say, hey, I can do this too. There's always going to be a way to find an analog. And really the only thing that these are good for is saying, hey, that's pretty cool. And that's why on this show, I like to dive a little bit deeper into things such as signal charts, market conditions, and so forth. We're going to start looking at seasonality here. This is the May market performance, and we're looking at the post-election years, 1950 to 2021. That's the dashed lines. And then we have the 2025 current performance. You have the dates here. And what do you notice? Well, typically in this area where we're at, about 510, you start to see a little bit of a pullback to consolidation. And even prior to that right here, these last couple of days kind of followed the path of a sideways consolidation. And then we get some sort of a mid-month type rally amongst the Russell 1000 and also the NASDAQ and also the Russell 2000 in the black line. And I think that this kind of goes good with my idea, seeing that the Russell 2000 post-election seasonality of a press higher could see some squeezy type names because they are typically smaller cap names that have that potential. So I think that that is kind of going into this whole scenario that we're talking about now. Can we see a deeper pullback? That is what it's suggesting, and a lot of the signal charts are showing us that there's a potential for that too. So if I look at the technology sector bullish percent index, we've been showing that it's at a pretty high rate. The last time we were in the 90 percentile or 90% here, you could see that we started going through a period of consolidation and a pullback of around 10% in the markets. Not to say that that's what's going to happen here, but that's what happened last time. And then the RSI is rather fried. I can show you the S&P 500 bullish percent chart too, which is also an overbought condition based off of the RSI here. But the reason why the technology sector is important is because these are the larger market cap names that have a lot of weight in the S&P 500, right? In the NASDAQ 100. So we're kind of getting a little frothy there. Even in the NYSE Composite Index, we do have a little bit of a bearish divergence forming on the NYSE McClellan Oscillator traditional calculation. And I've been watching these things for quite some time now, and they typically have a very good indication that we can see pullback. So the market kind of pressed higher here, but the readings are getting weaker. So what does that mean? The market's strengthening, but the internals are showing weakness. And if you look back through history and all these red lines that you see, we typically saw some sort of pullback, some sort of consolidation in the markets. This is the total put to call ratio. I like to apply a 10-day moving average to it. It's not really giving us an extended reading, but it is heading down, saying that bullish sentiment is increasing here. And if you look at the purple line in the background, which is the put to call ratio, not the 10-day moving average, we did get a pretty frothy reading, rather bullish reading here. And these can act as contrarian indicators. I personally like to look at when it's very extended to the upside and starts to cross down. I like to get more bullish there. And when it's down below the red line, I like to be a little bit more cautious, which is one of the reasons we started talking about bull traps up here, that led to a pretty large market decline. And we're starting to trend a little bit lower as it stands right now. If we look at individual investor sentiment bearish surveys, this is now the 11th trading week that we've actually seen a reading above 50%, which is, ta-da, the only time in history that we've seen that. And the reason I'm saying that here is, simply put, if you are bearish as an individual investor, you are part of the consensus, which doesn't necessarily mean you're wrong, right? You could be right, but these sentiment indicators are typically contrarian type indicators, meaning if everyone's on one side of the boat, and you want to be on the other side before it starts to capsize, and you want to equal things out. Once again, it doesn't mean that these guys are wrong or right necessarily at the moment, but it's been now 11 weeks, the most bearish it's been throughout history. So if you are bearish, once again, you are part of just consensus in the market. If we take a look at back month versus front month volatility, we're not at an extended reading. 1.2 would be an area where we're looking for price action to consolidate or pull back. And then below 1.0, we start to look for the market to find a base or bounce. If you look at back month versus, not back on the futures volatility curve, this actually changed a little bit here. First, we were in backwardation, which says, hey, we got problems here and now. And now, if you look at the June contract, July, August, September contracts, we're flat. So we're not really in backwardation. We're not really in contango. We're flatline, which just tells me that the market is uncertain in this current context, and it could be because they're waiting on pins and needles for whatever the very big announcement is, or whatever Trump has to say, or whatever new tariff news comes out that can really shake markets. So at a standstill, and you can see that in the price action. What did we do this week? This is one of the first weeks that we actually didn't even tag an expected move. One of the very few weeks that's actually the case. We are holding above the year-to-date VWAP as it stands right now. I want to hone really into this VWAP here from this prior swing low, because it's in confluence with an important level. We'll follow back on that in a moment. But as it stands right now, if you're looking at this, one thing a lot of people are starting to notice is this rising wedge. And rising wedges are typically bearish for the most part, right? But to be quite honest, all patterns to some extent, they all go through periods of expansion and contraction, right? This expanded, then you get a contraction, right? Bear flags, bull flags, and whatever the case may be. But I want you to be just aware that one of the common technical principles in technical analysis is that, right, markets move between periods of expansion and contraction to expansion. And right now we're in that period of contraction. So I think you need to be, if you're overly bullish or overly bearish, you need a plan for, hey, what if you're wrong? Because if you go too hard, too heavy right here because you're bullish and you're wrong, are you just going to hold on? Are you going to be too afraid to buy down at these lower levels if it comes there? And if you're very bearish, if it starts breaking out to the upside, are you going to keep averaging into that losing position? Are you going to give up, throw in the towel, and start to trade long? Have a plan for that. So I'm going to be mapping out some of the key levels and really kind of explain what I've been doing to hold a 20% year-to-date gain in the United States Investing Championship, which, by the way, at the end of this month, they're going to upload the results all the way through April, which I submitted today, and they have been officially received by the Norman who runs that championship. Now, if we take a look at gamma levels, where do we stand? We're gamma neutral. We're right at that flip line. However, this is also a very interesting area from a CTA perspective. So I'm going to be dropping you some of the levels to watch for potentially CTA activities to pick up in buying activity for projected buying. If we take a look at the call wall, it's at 5,800, and 5,800 would be up into and around this range over here. And then above that, we have a JPM collar, which they messed up their original trade, but I had the original ones on. I didn't feel like trading it. They're pretty similar in where they were at, but that's fine. 5,400 below us and 5,500 would be the levels if the market starts selling off from a gamma exposure level. So when we're in gamma neutral, when we're right there at the flip line, more neutral, this means what? It means that if we start slipping down, volatility can very well increase, because as far as dynamic hedging takes place, you can have selling but get selling, buying but get buying, where volatility typically increases, liquidity dries up. However, we can start kind of trading higher a little bit through this and hit some of these CTA projected levels. It could very well give us the opportunity where the dips start to get bought, and then they sell the rips. Dips get bought, they sell the rips. You get this slow grind higher, volatility comes in, and liquidity actually increases. That would be the more bullish case right there. Now, the level that I wanted to talk about with that green line, that anchor volume weighted average price from this prior low over here, you can see lines up perfectly with this lower expected move for the week. So for S&P 500 next week, our weekly implied move is 577.76 to the up, 550 and 92 cents to the downside. This is what the market's pricing in for risk leading to the week ahead. The daily implied move is, to be honest, quite large actually. And that makes sense because Mondays we've been seeing some outsized moves. So I wouldn't be surprised on a Monday we get some to move. I think on Tuesday we have CPI data coming out too, which can obviously shake the markets there as well. So my thought here is, simply put, if we start breaking down through these levels, I will be a buyer down in here for scaling into some S&P 500 position. I'd prefer to see a little bit of strength from those points, but that'd be maybe an initial scale. And then the following week, I'll look to see if we can draw in a little bit lower, and I'll start to leverage in more into my, not leverage, but buy in, scale in to maybe some longer term holds. Now that we've already seen the market fall 20%, maybe some of this is behind us. Now, on the other side of that, I'm still looking for very strong stocks that are setting up. And if we start breaking out to the upside, right, I'm going to continue adding exposure and names that look good in the overall markets. You may want to pay attention next week to the week-to-date volume weighted average price, last week's, because you can see it acted as a level of resistance multiple times, then it acted as support. So if we start breaking below last week's VWAP, perhaps that could be the door that opens the floodgates lower here. But if we can remain above it, I think that'd be a more bullish situation to continue to watch develop. If we look at CTA positioning, you can see it's starting to uptick here. They're becoming buyers in the very near term here. Some of the projected levels that we discussed, right, about 556.70, which is kind of where we're at in the S&P 500, they can become some bigger buyers. So maybe here, 5,700, 5,750, bam, we see a nice big pop up to and around 5,800. So that is kind of what I would be eyeballing here as far as CTAs go, in and around this projected area of 5,700, 5,750. If we can get through that, we may get some more buying activity from those CTAs that can really kind of help us obviously move these markets higher. And if you look at like vol control fund positioning, this was a surge, right, in vol control flows. And that can act also as a tailwind for the S&P 500, particularly if realized volatility stays suppressed, and could also fuel rallies or support pullbacks, even if we're in the absence of fundamentals. Now, you can see over here from early March-ish, right, down to February, this positioning collapsed dramatically, which increases the sell side activity that we've been seeing in equities because it causes these funds to de-risk. And this sharp recovery over here implies that volatility recently compressed, which it did as the market started moving more towards a gamma neutral environment back above that flip line. And that can trigger some inflows back into equities from these specific strategies. And that's kind of what we've been seeing here in recent trade in the markets. If we take a look at the Sailor to Shift tool, I like to give an update there. We did have a buy signal, buy trigger, crossed through 96,000, shot us up to 104,000. We notified you about the early turnover here if you like to front run it. I know a lot of people like to front run these things. Congratulations, you're more wrong often front run it, but if you every once in a while you get lucky and it goes in the right direction, and boom, this would have been a great time to front run it there in hindsight. But as this triggers the buy trigger, buy signal, and we see a big move, it's not just for Bitcoin. You can look at Ethereum or various crypto equities. So you can see here, we saw a nice move in coin. Now it's consolidating here sideways. MicroStrategy, Riot, Mora, which is not on my screen. There's Ethereum here, huge move. Bido, which is an ETF for Bitcoin. A CLSK still consolidating, but we saw some nice moves over here. IREN also consolidating, but saw a nice move. Cypher consolidating, but we saw a nice move over here too. And then Hut Mining has been seeing some higher lows and kind of going sideways, but we saw a nice recent move from and around the time that we started to see that rate of change increase. So it's positive to see this. And maybe that's a front-running signal, right? It's a risk-on asset. Crypto or Bitcoin's a risk-on type asset, high beta, typically strong correlation to markets. So is it front-running? Is it telling us that, hey, saying, hey, I don't care about your rising wedge. The market's going to be seeing an increase in exposure here in the very near future. And we'll know that answer in hindsight. So we got to continue to look for the names that are setting up and trade accordingly, and try our best to really manage our risk expectations in every trade that we enter. I'm going to hop into the squeeze list. Now, just a quick update here. I did a scan of some stocks that are 20% plus of high short interest, and I came up with some of these names over here so you can screenshot them, put them on your charts. But then I noticed, I was like, a lot of these names are actually reporting earnings really soon, like RGTI, right? It's reporting earnings, and this is a high short interest name, shaping up really nicely. SMR, I believe, is reporting earnings here too. Also tight consolidation, looking good. ASTS, very tight consolidation, but it's reporting earnings. And for me, I don't really like to trade names that are like about to walk into earnings. So I extracted the ones here that aren't having earnings, and I'll show you those. So, or that already had earnings. So EOSE, we had an earnings move, and now we're starting to consolidate this move back. It came to an around 7. And now, as we saw volume increase, volume's decreasing, and the moves are kind of pulling back here a little bit. So for whatever reason, right, the thought here is if the market gets some news or gets a tweet that it likes, and it just puts short covering into a panic that we've seen in the past, right? We saw this over here. The president came out and said it's a great time to, or something about buying stocks over here. It's a good time to buy. Well, then we saw shortly thereafter some news break and the market ripped higher. And now he's saying stuff about, just recently he said in an announcement or in the Oval Office, he said that it's a really good time to be buying stocks. And not to say that he's going to be right or wrong, but what that tells me is that probably has the people that are short based off of this, what happened prior, a little bit on edge, to say the least. At least if I was short and that came out and said that, I'd be like, oh, great, right? Which I'm not short, but you get my point. If we take a look here at AEHR, another one that looks like right at around this $9 mark, right? If we get some sort of something that sparks a rally like it did over here, perhaps we get a break from here in a short covering rally. And even if you want to enter earlier, right, just stay, if it's below $8, not really too interested, but if it can break and hold above $8.50, perhaps that opens the door for a nice pop here and potentially a little squeeze in a name like this. AAOI, also another one that went on a monster run, been coming way back in this down channel, and we've been kind of just chopping around sideways between 12.50 and 15. But if we get some sort of a pop higher, I mean, this could take us to around $20, which was this prior consolidation and breakdown area. And if that's the case, I mean, from 15 to 20 bucks, that's a large move, and you'd be looking at a stop maybe down here to start, but that'd be a reward of where you risk 1 to potentially get 2 on a trade like that. FFAI, another kind of cruddy name over here, Faraday, I think it is. I'm just calling out that we did kind of get a squeeze, and now it's consolidating, getting tight here too. So for whatever reason, right, if we get a bunch of short covering through this 1.2, maybe we go for 1.4, 1.5, or potentially higher, but it is flagging out over here. Volume's drying up, and the price action is getting very tight, which tells me that we're probably going to see a big move in the near future. My thought that it could be break higher, but The reason why I like it is because exactly where to get out, if you're wrong, because there's some clear levels. BBAI, which is Big Bear, saw a nice move here. Now we're seeing the sideways consolidation, pullback, and a flag formation, volumes drying up. So another high short interest name that if we start to break higher, maybe we go shoot for 3.75 or higher, which gives us, if I drew it out right here, right? This was the risk, this was the reward, right? You're looking basically at a 2-to-1 risk to reward right there too as well, or risking 1 to potentially get 2. Another one that's more popular name is Lemonade. Price action getting also very tight here. Looks like we kind of ran into this 32.50. So, where would you think of it in terms of this? Like if you were short this name, where would you get a little nervous and where would your stop loss hide? And perhaps that might be in and around 32.50. If we start breaking through there, maybe you're starting to bite your fingernails and it triggers some reactions for breakout buyers and for short covering and causes a pop up a little bit higher, maybe 35 to 37.50 there. So that's kind of the thought process there. Now, if you like these type of setups, maybe you don't like high short interest names and you want something a little bit more stable, like kind of what I trade mainly, which are just a little bit mostly more well-known names, larger market cap names and so forth. You can come into the Swing Trading Patreon group. You sync your Discord up, and every week I post my tight list, my updated watch list. Once a week, I give expected moves, daily, weekly, monthly, quarterly levels for a bunch of different names. You get also access to the comprehensive set of a tradie tick auto posting bots and the query channel where you can type in a bunch of different commands and receive the charts and the data for that. This is all $9 a month, and I didn't even list everything that we do offer in there. I have all types of stuff in there, and it's $9 a month. So the most you can lose out on is $9. If you want to save even more, you can sign up annually, and it's like ends up being $7 for each month, but you pay it annually. There's no refunds there, so make sure that you like it before you buy it. But it's sub $100 for an entire year, and I offer way more value than what you're paying for, hands down. That's just my personal belief there. That's all I got for you on today's episode. Hope it helps out, gives you some insight. I'll see you on the next.